What if I told you that the next 10 years will either make you financially free forever or leave you completely broke in retirement? I'm dead serious. We found the exact roadmap that separates people who retire with confidence from people who are still working at 75 just to survive, and we are giving it all to you right now. Today, we are covering 3 absolutely insane things every 55-year-old needs to know before it is too late. Number 1. The 120-month retirement roadmap, a step-by-step countdown that will change everything. Number 2. How to calculate your real retirement number, not some random generic figure, but the actual number built around your life. And number 3. The 3 asset buckets that could be the difference between retiring rich and retiring broke. The decisions you make in the next 10 years will literally determine the quality of the 30 years that follow. So if you are done guessing and ready to actually win at retirement, keep watching, because what comes next could change your entire future. Now let's talk about those 120 months, 10 years, standing between you and retirement. 10 years can feel like forever, or it can vanish before you realize what happened. The truth is, a decade is both a remarkable gift and a firm deadline. Most people dramatically underestimate what focused, intentional action over 10 years can actually produce. They assume they need everything figured out before they start, and that assumption costs them years of progress. Here is what I want you to understand right now. The 120-month countdown is not a rigid, color-coded spreadsheet that punishes you for missing a step. Think of it as a living checklist, something that breathes, adjusts, and grows with your circumstances. Life changes, plans evolve. That is expected. What is not acceptable is waiting for the perfect moment to begin. Starting imperfectly today will always outperform starting perfectly 5 years from now. Always. So let us begin. So let's start the clock. Years 10 through 9 are your foundation phase, and the single most important thing you can do right now is get brutally honest about where you actually stand. Start by calculating your complete net worth. List every asset, every account, every liability. Then pull together all your retirement accounts, your 401k, your IRA, any old employer plans you may have forgotten about. Next, visit ssa.gov and get your official Social Security benefit estimate. This number will surprise many of you, either pleasantly or uncomfortably, but either way, you need to know it. Finally, track down any pension benefits or deferred compensation you may be entitled to. Here is the truth. You cannot map a route without knowing your starting point. A GPS is useless without your current location. This assessment is your coordinates. Everything else in the next 120 months builds from exactly this moment. Now we move into years 8 and 7, and this phase has one mission: eliminate the financial weight that will drag you into retirement. High-interest debt, credit cards, personal loans, car payments. These are not just inconveniences. They are retirement killers. Every dollar you send to a creditor in retirement is a dollar your portfolio has to replace. The math is brutal. Your goal in this window is to aggressively attack that debt using either the avalanche method, highest interest first, or the snowball method, smallest balance first. Pick one and commit. Equally important is your mortgage. Entering retirement, mortgage-free, dramatically lowers your monthly income needs. Now here is the good news. If you are 50 or older, the IRS rewards you. You can contribute an extra $7,500 annually to your 401k and an extra $1,000 to your IRA as catch-up contributions. Use both. Every dollar counts now. Now we move into years 6 through 5, the income mapping phase, and this is where retirement planning gets real. By this point, you should have a clearer picture of your net worth and a debt reduction strategy in motion. Now it's time to project every income stream you'll have in retirement. We're talking Social Security, pensions, rental income, part-time work, and investment withdrawals. Write them all down with estimated monthly amounts. Here's where most people get a wake-up call: the retirement income gap. That's the difference between your guaranteed monthly income and what you'll actually need to spend each month. For example, if your guaranteed income totals $2,000 monthly, but your projected expenses are $4,000, you have a $2,000 monthly gap to close. Closing that gap, not just saving more money, is the central challenge of retirement planning. And identifying it now gives you years to solve it strategically. Now we move into years 4 and 3, and this is where most people make a very expensive mistake. They forget about healthcare entirely. Here is the reality. Medicare eligibility begins at 65. If you plan to retire at 65, you still need to bridge any gap between your last employer coverage and your Medicare start date. But if you are aiming to retire at 55, you are looking at a full 10-year window where you must cover healthcare completely on your own. That is not a small line item. Individual health coverage can easily run $500 to $1,000 per month or more, depending on your age and plan. Your options during this window include COBRA coverage from your former employer, marketplace plans through the Affordable Care Act, or a combination of both. But here is the most powerful tool available: the health savings account. If you are currently enrolled in a high-deductible health plan, maximize your contributions now. The money grows tax-free and can be used for qualified medical expenses at any age. Welcome to the final stretch of the countdown, year 2 to year 1. This is where planning becomes practice. The single most powerful thing you can do in this window is rehearse retirement before it begins. For at least 6 months, live on your projected retirement budget. Not approximately, exactly. This exercise will reveal gaps you never saw on a spreadsheet. You will likely discover subscriptions you forgot, expenses you underestimated, and lifestyle habits that cost more than expected. That is valuable information while you still have a paycheck. Beyond the budget rehearsal, this phase is about legal and financial housekeeping. Review every beneficiary designation on every account: retirement accounts, life insurance, and annuities. These override your will entirely. Update your estate planning documents, your will, power of attorney, and healthcare directives. Then sit down with a financial advisor and stress test your entire plan. Model market downturns, inflation spikes, and longer than expected lifespans. You want to find the weak points now, not after you have already retired. Here is the most important shift you need to make as retirement gets closer. For most of your working life, the goal was simple: earn more, save more, accumulate more. But in these final years, the game changes entirely. The focus moves from accumulation to distribution. It is no longer just about how much you are putting in. It is about how well everything you have built is organized, positioned, and ready to work for you without a paycheck coming in every 2 weeks. You could have a significant amount saved and still struggle in retirement simply because it is sitting in the wrong accounts or structured inefficiently. The final years of your countdown are about precision, not just progress. So you have done the work, you have followed the roadmap. But now the real question becomes, how do you actually know if what you have is enough? So now that you have a clear roadmap for the next 120 months, the next question becomes the one that keeps most people up at night. How much do you actually need to retire? You have probably heard the advice before. Save $1 million and you will be fine. It sounds clean, it sounds confident, and it is almost completely useless for your actual life. Here is the truth. A retired teacher living in rural Tennessee and a former executive living in coastal California do not need the same number, not even close. Generic rules of thumb are built for average people living average lives. But your retirement is not average. It is yours. The only number that actually matters is the one built around your specific lifestyle, your specific expenses, and your specific vision of what the next 30 years looks like. That is the number worth calculating. Now, before we can calculate your real retirement number, we need to understand something most financial calculators completely ignore. Retirement is not one flat, predictable expense. It actually unfolds in three very distinct phases, and each one looks completely different from the last. The first is the go-go years. These are your early retirement years, full of energy, travel, and lifestyle spending. You are finally free, and you are going to feel it in your wallet. The second phase is the slow-go years. Activity naturally winds down, discretionary spending drops, but new costs quietly start creeping in. And the third phase is the no-go years. This is where healthcare and care-related expenses take center stage, and honestly, this is the phase most people completely avoid planning for. Understanding these three phases is not just helpful, it is absolutely essential to building a retirement number that actually reflects your real life. Now let's break down the go-go years in real numbers. Picture someone retiring at 65 with a lifestyle they've been looking forward to for decades. Their budget might look something like this. Housing costs around $30,000 annually, travel and vacations hitting $20,000, dining and entertainment adding another $10,000, hobbies and fitness around $5,000, and miscellaneous discretionary spending rounding out at $8,000. That puts them at roughly $73,000 per year, before taxes or healthcare. Most people budget closer to $55,000 and are genuinely shocked by the gap. That difference of $18,000 annually, compounded over 10 years, represents nearly $200,000 in unplanned spending. This is why the go-go years consistently become the most expensive decade of retirement. You're healthy, you're motivated, and you finally have the time. The spending follows naturally. Planning for 20 to 30% more than you think you'll spend in this phase isn't pessimism, it's precision. Now let's talk about the slow-go years, roughly ages 75 to 85. This is where something interesting happens with your retirement budget. The big travel adventures start winding down. The frequent dining out becomes less appealing. Discretionary spending naturally contracts as your pace of life slows. But here's what catches most people off guard. The money doesn't disappear, it redirects. Doctor visits become more frequent. Prescription costs climb. You might need grab bars installed, a walk-in shower, or even a single-floor living arrangement. Long-term care insurance premiums, if you didn't lock them in earlier, can become a significant monthly expense. So when you add it all up, your total annual spending in the slow-go years may look surprisingly similar to the go-go years on paper. But the category breakdown is completely different. Less fun, more function. This shift matters enormously for how you structure your withdrawals and which accounts you tap first. Now we reach the phase most people refuse to think about, the no-go years, ages 85 and beyond. Ignoring this phase is one of the most expensive financial mistakes you can make. The average cost of assisted living in the United States currently runs between $4,000 and $6,000 per month. Memory care facilities can reach $8,000 to $10,000 monthly or more. Over several years, that adds up to hundreds of thousands of dollars. Long-term care insurance can help cover these costs, but here is the critical detail. Premiums are dramatically lower when you purchase coverage in your 50s compared to your late 60s or 70s. If assets are eventually depleted, Medicaid may become the only remaining option, which requires careful advance planning to navigate properly. The uncomfortable truth is this. Planning for your no-go years while you are still in your 50s is not pessimistic. It is the single most cost-effective financial decision you can make. Now let's bring all three phases together and calculate a real number. Here's a simplified example. Imagine spending $80,000 annually during your go-go years across 10 years. That's $800,000. In your slow-go years, spending drops to $65,000 annually across 10 years, another $650,000. Your no-go years average $80,000 annually in care costs across 5 or more years. That's $400,000 minimum. Before adding everything up, apply a 20% buffer for inflation and unexpected healthcare surprises. Your rough total approaches $2.3 million. Now, the 4% withdrawal rule suggests you need 25 times your annual expenses saved to retire safely. That framework works reasonably well for traditional retirees, but if you're retiring at 55, you're looking at a 30 to 40-year horizon, meaning the 4% rule may actually be too aggressive. Consider a 3 to 3.5% withdrawal rate instead for greater long-term security. Now, here is something most people in their 50s never stop to consider. Think about where the majority of your wealth actually lives right now. For most people, the honest answer is a traditional 401k, maybe a traditional IRA on the side. And on the surface, that sounds perfectly reasonable. You have been saving diligently for decades, watching that balance grow, feeling good about where things stand. But here is the problem. Nobody talks about at the kitchen table. Having all of your retirement wealth sitting in one type of account creates a hidden tax risk that can quietly drain your retirement income in ways you never anticipated. Every dollar you pull from that 401k gets taxed as ordinary income. No exceptions, no flexibility, no strategy, just a tax bill year after year. So the real question is not just how much you have saved, it is where you have saved it. And that distinction changes everything. Now let's talk about the first asset bucket every 55-year-old needs, the taxable brokerage account. Unlike your retirement accounts, this one comes with no contribution limits, no required minimum distributions, and no restrictions on when you can access your money. That flexibility alone makes it incredibly valuable in retirement. When you sell investments held longer than 1 year, you pay long-term capital gains tax rates, which are significantly lower than ordinary income tax rates, often 0, 15, or 20%, depending on your income. Here's why that matters strategically. In retirement, you get to choose which accounts to pull from each year. If your taxable brokerage account is well-funded, you can draw from it during years when you want to keep your taxable income low, staying within a favorable tax bracket, avoiding Medicare surcharges, or reducing how much of your Social Security gets taxed. That kind of control is something most retirees never even realize they're missing until it's too late. Now let's talk about the second bucket, tax-deferred accounts. This includes your traditional 401k and traditional IRA. These are the accounts most people are most familiar with, and for good reason. When you contribute, you get an upfront tax deduction, meaning you reduce your taxable income today. And inside the account, your money grows completely untouched by taxes for decades. That compounding effect is genuinely powerful over time. But here's the hidden cost that most people overlook. Every single dollar you pull out in retirement is taxed as ordinary income, not at the lower capital gains rate, but at your full income tax rate. And it gets more complicated. Once you reach age 73, the IRS requires you to start taking required minimum distributions, whether you need the money or not. Those forced withdrawals can push you into a higher tax bracket, trigger Medicare surcharges, and create a tax burden you never planned for. Now let's talk about the third bucket, and honestly, the most underutilized one. Tax-free accounts, specifically the Roth IRA and Roth 401k. Unlike the tax-deferred bucket, contributions here are made with after-tax dollars. But here's the powerful part. All growth and every qualified withdrawal in retirement is completely tax-free. Not tax-deferred, tax-free. That distinction matters enormously. For a 55-year-old, the Roth is especially compelling. You still have a full decade of tax-free compounding before retirement. That means every dollar growing inside a Roth works harder because the government never takes a cut on the back end. And if most of your wealth is sitting in traditional accounts, Roth conversions are your rebalancing tool. You strategically move money from tax-deferred to tax-free, paying taxes now at potentially lower rates, so future withdrawals cost you nothing. It's one of the smartest moves available in this window. Now imagine bringing all three buckets together. A retiree with taxable, tax-deferred, and tax-free accounts has something incredibly valuable: flexibility. Let's say you need $80,000 annually. Instead of pulling everything from your 401k, you strategically draw $20,000 from your brokerage account, $30,000 from your traditional IRA, and $30,000 from your Roth IRA. By blending these sources, you stay within a lower tax bracket, avoid triggering Medicare income-related monthly adjustment amount surcharges, and reduce the size of future required minimum distributions. Now contrast that with someone who only has a traditional 401k. Every dollar they withdraw is taxed as ordinary income. They have zero flexibility. As required minimum distributions kick in at age 73, their taxable income spikes whether they need the money or not. Tax diversification isn't just smart, it's the difference between controlling your retirement income and being controlled by it. Knowing your number is 50% of the battle. The other 50% is having a real, actionable plan to actually hit it. So here is what I want you to do right now. Drop a comment below and tell me this. Does your retirement number feel realistic, or does it feel like a serious reach? Be honest, because your answer matters more than you think. If you looked at your number today and felt a knot in your stomach because the gap feels too wide to close, do not panic and do not go anywhere. My next video is built specifically for you. I am breaking down aggressive catch-up strategies for people who feel behind, and I promise you there are more levers you can pull than you realize. Click right here to watch it next, and let us close that gap together.